Welcome to The Explainer. Today, we're going to pull back the curtain on the one number that can literally make or break a company. It's a figure that CEOs use to either greenlight or kill billion-dollar ideas. It's kind of like a magic number. And by the end of this, you'll know exactly what it is and how it works.
Okay, so let's just dive right in. Picture this. You're the CEO of some huge company. You've got two amazing projects on your desk, but you only have the cash to fund one of them. So how do you possibly choose? This is a massive gamble, and your gut feeling just isn't going to cut it when the company's future is on the line.
To make these enormous bets, companies use something called a hurdle rate. Now, think of it like a high jump bar in the Olympics. Any new project, any new idea has to promise a return that's high enough to clear that bar. If it can't make the jump, it doesn't get the money. It's really that simple.
So what is this hurdle? What is this magic number? It's not just some vague idea. It has a very specific, if not a little clunky, name in the world of finance, and it is the absolute key to understanding how these massive decisions get made. It's called the weighted average cost of capital. Yeah, it's a mouthful, so everyone just calls it WACC. Put simply, WACC is the price a company pays to use other people's money to run its business. And if a new project can't earn a return that's higher than this price, well, then it's not just failing to add value, it's actively destroying it.
So how in the world is this WACC number calculated? It's not just pulled out of thin air, I promise. The best way to think about it is like a financial recipe. And this recipe has two main ingredients which, you guessed it, represent the two main ways a company gets its hands on cash.
The first ingredient is debt. Now, this is the pretty straightforward part of the recipe. It's the money that company borrows from banks, or maybe by issuing bonds. The cost here is simply the interest rate it has to pay on those loans. Easy enough, right?
The second ingredient is equity. This is money from investors who buy the company's stock, becoming part owners. And the cost here, well, it's a lot trickier. It's not some fixed interest rate. No, it's the return those shareholders expect to get for taking the risk of investing in the company in the first place.
And here is the formula that puts it all together. Now I know, this might look a little intimidating, but don't worry. All this is doing is blending the cost of that debt and the cost of the equity. And then it weights them based on how much of each the company is using. We're going to break down every single piece.
Understanding this difference is just so important. Lenders, the folks who provide the debt, they get a fixed, predictable interest payment. For them, it's a lower-risk game. But shareholders, who provide the equity, they get a piece of the action, which could be huge or it could be zero. It's way higher risk, but the potential reward is much, much bigger. WACC has to balance both of these realities.
All right, now we're going to dive into what is by far the trickiest part of this whole WACC recipe, figuring out RE, which is just the fancy term for the cost of equity.
I mean, this really is the million-dollar question, isn't it? An interest rate on a loan is written down, it's in a contract, plain as day. But the return an investor just expects, that's in their head. How on earth do you put a number on an expectation? Well, to solve this puzzle, financial analysts have come up with some pretty clever models.
One really popular method is the dividend growth model, and it's based on a pretty simple idea. An investor's total return really comes from two things: the cash dividends they get in their pocket and the growth in the price of their stock. So this model directly connects what the company pays out to what its investors hope to earn.
Another famous one is the capital asset pricing model, or CAPM. Now, this model defines the expected return all in terms of risk. It starts with a super safe baseline return, like the interest you'd get on a government bond, and then it tacks on an extra premium to pay investors back for taking on the specific risks of that particular stock.
So you see, even though these models use totally different approaches, they're all just different roads leading to the same place. They are all trying to quantify that one super elusive idea. What return are our shareholders demanding for us to use their money? And the model a company chooses actually tells a story. A stable company that pays regular dividends might use the dividend growth model. But a fast-growing tech startup that reinvests every penny, they'd probably have to use a risk-based model like CAPM.
All right, we have officially gathered all our ingredients. We know the cost of our debt, and we've got a really solid estimate for the cost of our equity. Now it's time to follow the recipe and calculate that final magic number. It's really just a methodical four-step process. First, we nail down our costs for debt and equity. Then, we figure out the weights. Is the company funded 30% by debt and 70% by equity? Or is it the other way around? And finally, we just plug all of those numbers into our master formula.
And here it is again, our master recipe.
Now that we have a value for every single variable in this equation, it probably looks a lot less scary. We're ready to combine the weighted costs and get our final answer.
So after running all the numbers for our example company, we finally arrive at our WACC, the magic number. That financial hurdle rate that's going to guide every big decision is 21.13%.
And this, right here, is the moment of truth. That 21.13% becomes the ultimate benchmark. A proposal for a new factory that's projected to return, say, 18%? Rejected. A new product line that's expected to bring back 25%? That gets the green light. It's a clear, incredibly powerful rule for creating value.
So why does this one number matter so much to anyone who isn't an accountant? Well, because it forces discipline. It makes a company be smart and strategic about where it puts its money. It ensures that it only invests in the things that will actually make its owners, the shareholders, richer.
And that wraps up our look at WACC. But we'll leave you with this final thought to chew on. This number isn't set in stone. It's deeply tied to the entire global economy. So what do you think happens to a company's magic number and all of its big future plans when interest rates around the world suddenly go up?